all policy changes have a lag, right, effect before they hit the economy. So we have not yet seen the full negative effects of what the Fed has already done.
Hi, I'm Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for October 18th through October 25th, 2022. This week we featured 2023 Britannia in silver and in gold. Though the UK's Royal Mint has finalized a portrait of King Charles III and has started minting commemorative coinage with his image, the Mint made the unexpected choice to issue this first run of 2023 Britannia, still bearing the portrait of Queen Elizabeth II. The silver Britannia comes in tubes of 25 and mint fresh monster boxes of 500 coins, and is available at only $7.50 over spot. The gold Britannia is $85 over spot while this shipment lasts. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Adrian Day from Adrian Day Asset Management. Adrian, thank you so much for joining us today.
Thank you, Elijah, very much for having me. I enjoy these.
Well, it's great to have you, and we really appreciate all your insights you bring to our viewers here. I would like to discuss the news of the day. We're seeing precious metals spike a bit and also the stock market rise. And it seems like this is on news that the Fed may be questioning, well, should they continue to raise rates at this rate? It looks like we're going to probably see a 0.75% rate hike at the next Fed meeting, but some Fed officials are questioning whether, those rate hikes would increase or the Fed would continue to increase at that rate. So your perspective on what we're seeing right now and talk at the Fed.
Yeah, in some ways, the narrative really hasn't changed, except that, last month, the month before, the emphasis was on, continuing to hike rates until we reach our terminal rate and so on. Now, I think the market was expecting a slowdown in the increase in rates next year. But now the emphasis seems to be on when we're going to pause and when we're going to slow down. And I think you're absolutely right. We were talking before, it's become pretty clear that these rates are already having an impact on the economy. They're having an impact on corporate earnings. They're having an impact They will have an impact on employment because a lot of companies are talking about hiring freezes and layoffs. And I think the other thing we must remember is all policy changes have a lag, right, effect before they hit the economy. So we have not yet seen the full negative effects of what the Fed has already done. That's very important for us to realize. A lot of people are saying, well, gee, the economy is very resilient. It's holding up very well in the face of these cuts, of these hikes. But it always takes time for those hikes to have an impact on the economy. And let's not forget that this is the most rapid increase in rates ever. We've gone from essentially 0 to 3.25, and as you say, probably another 75 coming up soon, in the space of 4 or 5 months. That's far more dramatic than even what Volcker did in 1979-80. When he took rates from like 10%, we forget rates were already high when Volcker came in, from 10% to 18%. And I'm not taking anything away from what Volcker did, but what's just happened is far more aggressive in terms of hiking because of the percentage increase. And also the timing. And, if you think about this impact on the economy, I don't think in 1979, there were a lot of people saying, wow, rates are 10%. Let's go out and borrow a lot and lever ourselves up and buy a lot of worthless companies and, let's go crazy. At 0%, a lot of people there was a lot of borrowing of money, ramping up of debt. And because of that, you've got bad investments, malinvestments. So you have the debt to GDP now at about 130%. Back in 1979, it was 30%. So a huge difference.
It does seem like there's a lot of differences when we look at the economic environment today than the 80s. One of the things you mentioned, though, when the Federal Reserve is making these decisions about rate hikes and analyzing what's happening in the economy and what is happening with inflation, in your recent quarterly newsletter, you mentioned that Jerome Powell himself has said that the money supply is not something that they consider. So that seems kind of odd because at least on an Austrian view, that would be probably the biggest factor to what inflation is.
I think when you say odd, you're being very, very kind. And it's not just Austrians, of course. It's monetarists, it's Friedman, and it's sort of what we used to be taught in basic economics 101, This was at the Cato Annual Monetary Conference, and I was scribbling away, taking notes on what he was saying, and I almost fell off my chair. Monetary aggregates, which is a fancy way of saying the money supply, monetary aggregates do not figure significantly into our decisions on monetary policy. They're discussing monetary policy and they're not looking at the money supply. This is really quite astonishing. And, the thing I would say is it's more than just astonishing. If you do not understand the causes of inflation, which the Fed and the administration don't seem to, because they talk about the Russian invasion of Ukraine, they talk about the Chinese COVID lockdowns earlier this year. You only have to look at a graph of CPI going back for 18 months to see that it was rising dramatically before Ukraine, before the Shanghai lockdown. But if they don't understand the causes, how can we truly expect them to get the solution right? And yes, the Fed is hiking rates, but the administration is continuing to spend money, as much money as it possibly can, much of it without getting approval of Congress. So you don't fight inflation by spending more money. That's pretty obvious and pretty basic too, I would think. But, Powell himself, the other wonderful quote, this was in August at a conference in Lisbon, and I think he was trying to be humorous when he was asked what he had learned over the last 12 months. And he said, well, the most important thing we've learned is that we don't really understand inflation. And I thought, boy, you hit the nail on the head there.
It definitely seems like they don't understand inflation based on, what their projections were. They were thinking inflation was going to be transitory. So where do you see inflation heading from here if, the people controlling the monetary system and the money supply and rates don't actually understand what is causing it?
You're right. Well, you're right. Not only looking backwards, the transitory narrative and all that, but even if you look at what the Fed is looking at today, with their dot plot, they're looking at 2.6%. They're looking at 5.7% inflation for this year, 2.6% for next year. We're going to be very, very lucky to get 2.6% to get inflation down that low next year, in my view. One of the problems with inflation always is that it builds on itself, as we know. If you think prices are going to continue, if you think prices are going to be stable for the next year, you don't have a particular incentive to go out and spend that money, because it'll still be worth in 12 months what it's worth today. But if you think inflation is going to continue to rise, there's an incentive to bring spending forward as much as you can. So people start stockpiling. They start stockpiling, basics, paper towels, and so on. An anecdote, if I may, in Zimbabwe at the we always say height, but it really should be the depth of the inflation that they had there. You'd walk into a restaurant and you'd pay your bill before you sat down and ordered. Because if you waited to pay your bill at the end of a meal, it would be more expensive than when you walked in. Now, that more mild inflation can have the same sort of impact. As I say, you start bringing things forward. Shall we do this? We need a new washing machine. Gosh, we better buy it now before prices go up. And so inflation can build on itself. The other thing, of course, is that by having a strong dollar, the US has been able to export a lot of its inflation to other countries. And that, as you know, is causing consternation among many countries, both their allies in Europe, who are facing a bad winter energy-wise, but also among many emerging countries who feel the full brunt of this. If for whatever reason, we can discuss it if you want, but if for whatever reason the dollar comes off a little bit, 10, 20% even from the recent peaks, then that will be another factor continuing to push inflation up. Two other factors. One is that labor and unions probably have more pricing power today than they did 2 or 3, 4 years ago. I'm not in the camp that thinks they have extreme pricing power as they did in the 1970s for a lot of reasons, but certainly they have more pricing power than they did 2 years ago. And if the average wage increase in the last 12 months is 5.6% and the CPI is up, 8.5%, you're still falling behind. And workers are not stupid. They see that, they realize that. So there's going to be more pressure for more wage rates. That pushes the cost of living up. And lastly, onshoring. If the era of globalization is over, or at the minimum, companies are sensing maybe we shouldn't be just-in-time inventory anymore. We should maybe, have a little bit of a cushion there. That also increases costs. Now, you and I both know, and we need to emphasize this, we're throwing around the word inflation, but costs going up, whether from wage rates or from oil or from onshoring, is not inflation. Inflation, the definition of inflation in the dictionary used to be increase in the money supply. That used to be the definition. But the inflation's already happened. The CPI going up is simply the symptom of that inflation. And it evidences itself in different areas. It evidences itself, 6 months, a year ago in used cars. It evidences itself in, the cost of petrol. But all of those are depending on, peculiar circumstances. But the cost of living across the board is going up because of the inflation we had in the money supply.
And it really does, ultimately, it seems like, have to do with the inflation of the money supply there. And as you mentioned, that is the definition of inflation, is the increase in the money supply. And at the end of the day, also the effect of these rising prices is another way that a client I know has talked about inflation. And they said, we should just call it, instead of inflation, using that technical term, we should just call it central bank theft. Because at the end of the day, it's taking wealth away from, it's taking purchasing power away from the holders of dollars and putting it in the hands of those creating the currency. But I would like to ask you, how do people protect themselves against this theft of the prices rising, their wealth deteriorating because of inflation? How do people protect against that? What sort of sectors should people be looking at right now?
Well, gold and other precious metals, but gold primarily is the obvious and the first one. I know a lot of gold investors are very, frustrated or even upset at the action of gold this year in the face of what we've seen. And I'm sorry, Elijah, I didn't look at the numbers before I got on the interview. But, as of last week, when I was at a conference Friday, we were looking at gold down about 8% for the year, the dollar up about 18% for the year. So in the face of a very strong dollar, gold is really holding up quite well. We shouldn't forget that. And if you look at gold versus the S&P versus the world index versus, dare I say, Bitcoin, again, gold has held up very well this year. So although it's frustrating for dollar-based investors to see the price of gold go down, let's not forget that the dollar has been remarkably strong. And when the dollar turns, gold will do very well. So I think gold will be the number one, gold stocks also. Secondarily would be other commodities generally. And that would include, for me, that would be primarily commodities where there is the possibility of supply constraint as well as an increase in demand. So oil, gas, and copper would be my favorites on the broad commodity space. But, we're also investing in other things at other time, depending on the timing, depending on the price. On the longer term, uranium is also very attractive. In terms of markets, and that would be both the commodities and the stocks, and those are the sectors that have done traditionally, historically, have performed very well in a stagflation period. And, stagflation obviously means stagnant economy with inflation. We'll be lucky if we get a stagnant economy with inflation. We're going to get a recession before they've killed inflation. So we're going to, I don't know what the word for that is, but recessflation or something. But in a stagflationary environment, gold stocks, commodities, and commodity stocks tend to do well. The other sector that does well are smaller markets, not the major developed markets like the US or Europe or Japan. Now, some of that depends on what happens to the dollar. If the dollar declines, then I think you're going to see some smaller markets do particularly well, particularly the countries that have to import resources, natural resources. So countries like Singapore, for example, Hong Kong, they will do very well. But because commodities are doing well, also the exporters like Brazil will do well. And lastly, we would look at opportunistic, I was going to say opportunistic opportunities. That's tautology. But, where you see a particular circumstance, but you don't think it's going to last very long. So if you look at Britain, UK market right now, and as a Brit, I have to say I'm incredibly embarrassed at the circus that's been going on over there. But if you look at the UK right now, you have a very low pound and you have very depressed stocks. So for US dollar investors taking advantage of a weak pound, British stocks are remarkably inexpensive right now. You can see stocks trading in single-digit PEs where you expect the earnings to continue and yielding, some of them yielding 5 or 6%. And so I think it's a great opportunity to take advantage of that. We may want to hold them, for 3 months, for 6 months. I don't know. We may want to hold some of them maybe for a much longer period of time. But it's essentially a trade because of what's happening over there. So I think in this kind of environment, and I think we're in a bear market, by the way, I should have said that. I think we're in a bear market. So in a bear market, you'll always get opportunities, you'll always get rallies, but you have to be pretty opportunistic about it. Unfortunately, I say unfortunately, pretty short-term oriented about it.
Now, when it comes to the dollar, you mentioned before that the rally may level off here. We've seen just in the last week a lot of foreign buyers of U.S. dollars, and we have seen just an incredible rally, and it's still around 20-year highs. Your perspective on where we're going from here, and then how that can impact the other markets?
Yeah, I'm in two minds on the dollar, right? Because if you looked at the dollar in isolation, there's no question with the high twin deficits in the U.S., a budget deficit, a trade deficit, the currency is inherently overvalued. But of course, currencies have to be priced against other currencies. And as they like to say, it's a cleaner shirt in a dirty laundry hamper. So, the dollar is benefiting, or the dollar has benefited and continues to benefit grow from the perception that the US economy, however negative the outlook might be, still has a better outlook than Europe and some other countries, Japan, even China, where although it's still growing, the rate of the rapid decline in the rate of growth, makes people a bit concerned about China. But the other factor, of course, is the interest rate differential. Although Europe put up their rate 75%, they put them up from 0 to up 75 basis points. Britain is 1.25% or whatever. Japan is doing whatever Japan always does. And so if you're a foreign investor, let's say you're sitting in Switzerland with $20 million to park, and you look at the US economy, better than Europe and better than Britain and better than Japan, and you look at the fact that you can earn 2 and a bit % on a 1-year T-bill, or you can earn 4% on a 2-year T-bill. Well, now you're talking about real rates of interest compared with what you can earn in Europe. And so the dollar's a prime beneficiary of that. I'll just say, interestingly, if you look at the numbers of foreign buyers, the report you referenced, it does appear, and these things can change, of course, from month to month, but it does appear that most of the buyers would be either private investors or hedge funds. So they're either hedge funds who are buying, say, 2 years, because if the terminal rate is 4.5% and you can earn 4%, you don't have too much downside, but you have the potential once the Fed stops for a rally in that 2-year. So they're either hedge funds trying to take advantage of that, or individuals who are just saying, well, if I can earn 2% on a 6-month T-bill, that's better than nothing in the bank. You're not seeing long-term permanent buyers like, central banks. And I think that's significant because the hedge funds, of course, can change their mind quickly.
One of the other things is if you could share with our viewers, because a lot of people on our channel are obviously interested in the precious metal sector. So if you could kind of boil down for our viewers some of the things that need to happen before precious metals turn around, because I know you are looking for a turnaround soon, but obviously we haven't seen a dramatic turnaround yet.
Well, I think one of two things has to happen, and they could both happen at the same time, but one of two things has to happen. Either we have to see a decline in the dollar, and I'm not sure that's going to happen anytime soon, or more investors have to realize that the Fed cannot achieve its inflation target without causing a serious recession. They don't have to pause, let alone pivot, but investors have to realize that they're not going to be able to achieve their target. And at that point, I think, and of course, that's not a point. Sorry, that's, it happens slowly. It's not everybody wakes up one day and says that. But when more investors realize that, then I think gold is going to do well. Let's not forget, gold can go up even if the dollar's appreciating. So it's not a matter that the dollar has to go down for gold to go up. And let's not forget that. But as investors realize the Fed cannot achieve its targets, I think gold is going to reverse. And today's action, as you mentioned, today's action in response to talk about slowing down or pausing later in the year or next year, gold's action 2 weeks ago in response to the Bank of England pivot, although they don't call it that, but saying, well, we were going to start QT on Friday, but instead we're going to start buying bonds instead. Pretty amazing. So gold's reaction in the last month to events or developments like that, I think is very, very encouraging.
We can't predict the future, but it almost seems inevitable to me that investors will wake up to notice that the Fed can't control inflation, because it's like, I don't see how they actually can, because you can't raise rates high enough to quell this inflation, because if they do, the interest payments on the debt would just be too high.
No, you're absolutely right. I love your thing about we can't predict the future. Yeah, I'm pretty good at predicting the past. Actually, I've done quite well in that. But you're absolutely right. And at the moment, although in what I'll call lovingly the gold bug community, we don't believe the Fed. But we shouldn't forget that we're a sort of small minority community. If you look at investors overall, investors are still believing the Fed narrative, and gold and tips and bonds. And all these things are a reflection. They're acting as a reflection that investors actually believe the Fed. If you look at investor expectations for inflation, they are almost identical to the second decimal point with what the Fed's dot plot on inflation is. Investors are expecting 2.9% inflation next year. Well, if you're expecting the Fed to bring inflation down and get to 2.9% next year and 2% longer term, you're not going to be particularly attracted by gold at this point. But in a way, for a contrarian, this is all very encouraging. It's encouraging that most people are believing the Fed, but most people they don't dislike gold at this point. They don't care about gold. And that's the most extremely negative sentiment you could have, right? Just, we don't care. What that means is that when the sentiment changes, we have the potential for pretty dramatic moves, I think, because everybody moves in, buys 1%, 2%, whatever it is, because everyone's underinvested at this point.
Everyone definitely is underinvested, especially when it comes to precious metals. It's at so low levels right now. And even as we're seeing just a few, a little portion of investors getting into, especially the physical market, we're seeing physical metal dried up as well.
Yeah, absolutely. Well, you know more about that than I do, obviously. But I mean, the spreads in physical are really quite astonishing. So there is this underlying demand and perhaps also a shortage of the physical commodity. So, yeah, I think when the sentiment changes, things could move pretty dramatically.
All right. Well, Adrian, it'll be fantastic to have you on and discuss when we see that happen, have you back on and discuss that. Where can our viewers find you online if they're interested in learning more?
Adrian Day Asset Management.com.
All right. Adrian, once again, thank you so much for your time and God bless.
Thank you. God bless.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.